Hi everyone, this is Jeff Ong for Dr. Wealth. Now, today I'm going to talk about what kind of investor are you? Are you a flip or are you a buy and hold type of investor? But first, a disclaimer, opinions about property investing will be expressed in this video. They should not be taken as recommendations or investment advice. Now, flip is very possible even in Singapore. It's been done by contractors 15 to 20 years ago, back then when a terrace house could be bought for as little as 800 to 900,000 and then spending maybe 300 to 400,000 to refurb it. And usually they are single story terraces. I think those of you who are born in the 80s will have known, those very old terraces, and it wasn't very sought after, right? And once they refurb it, the total cost could be close to 1.2, and then they were selling at 1.5 to 1.8 million. It was done, it was possible for small-time developers about 15, 20 years ago, right? So today it is quite impossible. And later on, I'll explain to you there are big ticket items in Singapore right now because the costs have gone up. So I did not flip in Singapore. I went to Glasgow to flip. And this is an example of what a flip is and what the profit is. Last year, July 2020, at the height of the COVID crisis, I did a flip project. When everyone was panicking and being locked down, I managed to acquire a property, a terrace in Glasgow for £116,500. Now, the fees and refurb was £23,500. The total cost or gross development cost was £140,000. Bridging loan, we borrowed from friends and family, was £100,000 at 8% per annum. Well, it is a win-win situation to get a bridging loan because some people, they want the certainty of being paid back at the end of 1 year, and they want to be secured against the property itself. So it's a win-win because putting it to the bank or buying a bond, it could be either 0% for a bank deposit or 4 to 5% to buy a bond. And we are paying 8% per annum. So we raised equity of £40,000. Okay, so add both together, 100,000 bridging plus equity, 140,000, it adds up to 140,000. That's how I come up with that number. Now we sold at 170,000, net of costs and taxes is 165,000. Now the profit is 25,000. We had to return the bridging loan within 6 months plus interest because we flipped it, right? We had a very good contractor and we had a whole power team there, people who sourced it, refurb it, and sold it. So we got the best agent to sell it. We got the best sourcer to buy something that is distressed. So we had to return the bridging loan plus interest of 104,000. That leaves 61,000 pounds of proceeds to us. The return in 6 months was 52.5%. How we get that was 61,000 divided by the equity, which is 40,000. Annualized return is 105%. So naturally, you just multiply by 2. So this is an example of a flip project of putting in 40,000 pounds of equity ourselves and getting 25,000 pounds in return of profit, right? So pros and cons of flip. Pros: 1, able to get good cash flow, 2 to 4 projects a year. And I think in the past, small-time contractors in Singapore were able to get pretty good returns. And it's the same thing. They do not fund the entire project themselves. They took a bridging loan from friends and family, and that fund, and they put in their time, hours to find their property, refurb it, lead a team, do project management, and finally sell it, right? That's number 1. It can be good cash flow. Number 2, suitable when you have a group of trusted builders, subcontractors on site. So normally the flippers are the ones that start out as contractors and they become small-time developers. 3 is if they are unable to sell, usually they can keep for rental income because you built it at cost, right? Your break-even is faster and the yields are higher, better, rather than when you buy new off-plan and then with the developer's profit is much higher, right? Number 4, you do not need to really get a mortgage or bank loan if you manage to flip it profitably, right? It's just to pay off the bridging loans. Cons: be prepared for cost overrun by 30 to sometimes 100%. It is even during this COVID crisis, material costs have gone up by 30 to 50%, and workers are few because they cannot come into the country to work. So be prepared for that. And it's really unforeseen, right? Number two, once you sell, you forgo the future upside. Now, this is a key thing. I generally don't like to flip unless I want cash flow. You can also get cash flow from rentals. So I will show you later on the later slides how much property prices have appreciated. So if you flip, you totally miss the upside. Number three, if you are not a contractor or builder yourself, sometimes they can take the bulk of your profit, leaving you with very little. Remember, putting in the capital, your own capital is at risk. If you can't manage the builder or contractor well, they just want to, earn their fees. And if something goes haywire, the costings are not accurate, it wipes out your profit. And to a contractor, they have very little risk, right? Or they come in, they provide their workers, and then they charge a margin, and the risk of selling at a profit is all incurred by you. So number four, not tax effective, as once you sell, there's capital gains tax in some countries, or corporate taxes even in Singapore. And of course, you do projects under companies. You don't put it under individual name because there may be liabilities, and you don't want them to sue you personally, right? So B4R often incurs less taxes. They only tax on your rental profit and eventually inheritance tax. So if you don't need to sell and you keep refinancing to the very end, there is hardly any capital gains or no capital gains tax. So you never need to sell, right? So you can see pretty much the pros and cons are quite even. Now, buy and hold. Let me show you an example of buy and hold. Again, pretty much in the depth of COVID last year, we bought a property in Birmingham on 17 November. And we bought that semi-detached for £286,000. The fees and refurb was 54,000. The gross development cost, when you add both together, is £340,000. Now, again, we borrowed a bridging loan of £200,000. Okay, that is roughly about 60% loan to value ratio. So the bridging lenders are very happy because the LTV is not very high, right? 8% per annum of interest. The equity that we put in is £140,000. Lo and behold, valuation report thankfully came in at £360,000. So they recognize our refurb costs because we bought the cheapest house on one of the best streets, right? And it could have been bad, it could have been 290, and then they recognize it at our purchase cost, but they recognize that we put in a lot of refurb costs as well. So this is what I meant by refurbishing well that adds value. So right, so the money left behind after mortgage is £54,000. Expected net return after mortgage, okay, is 14,400. Now that is the net profit after mortgage. So we are expecting to get a mortgage of 75% loan to value ratio. We are expected to borrow £270,000. Okay, so £270,000 from a mortgage at about 3 to 4% interest is more than enough to pay off the bridging loan of £200,000 plus interest, right? It's likely to be about 220. So comfortably, we can pay off the bridging loan, plus we could even return some money back to the equity investors. So the return on investment is 26.7%, okay, including profit is 63.7%. I left out that there's an unrealized profit of £20,000. Now remember, gross development cost was £340,000. Valuation report came in at 360. So 360 minus 340, we had an unrealized profit of £20,000. Now, return on investments was simply the net rental income of 14,400 minus off the money left behind after paying off mortgage of which is 54,000, and you get 26.7%. But if you add in the £20,000 unrealized profit is 63.7% return on investments. Now, this return is pretty good. It may not be as good as a flip project on an annualized basis, but at least I get back a lot of my money and I'm only left behind £54,000. The success of a project is how much money you left behind. Now, here's another thing about buy and hold, which is more important than flip. In 2021, 24th July, this is the article I extracted. The ratio of house to apartment is 2.84. Okay, right? Do landed properties have more upside to go? I dare say that it will one day supersede or climb up to be equal with the condos average price per square foot, because there's no more supply of landed, whereas condos have unlimited supply. You can unblock it and build as tall as possible. So guess which one is likely to appreciate faster? It is landed. Now here's a look at the property index. First quarter 2000, that was 21 years ago, landed price index was 98.9. Second quarter this year is 184.8. If I were to extrapolate back, in year 2000, the average price is 2.709 million. The median will roughly be 1.5 mil to 1.4 mil. Okay, it has appreciated 4.5% per year in the 21 years, and the increase is 87%. Now, non-landed, referring to apartments, condos, 21 years ago was 100.7 for the index. Second quarter 2021 is 158.8. Price in 2000 average is 1.129 million. Probably the median is about 900,000. There was a 57.7% increase, which is only 2.3% per annum. So the house price to apartment ratio in 2000 was 2.4 versus 2.84 now. So you can see that the increase in supply of apartments has caused it to lag behind in capital appreciation, and this gap is likely to increase because of the rare factor. And as more people migrate to Singapore, this gap may increase. So indeed, land is scarce and land appreciate and buildings depreciate. Remember this. Now, if you like this YouTube so far and you find it useful, please like and subscribe. It helps in the algorithm. It will appear every time I produce videos. They're entertaining and they're informative, and hopefully it helps you in your investment decisions. So you can see that flipping is almost very difficult for a small-time developer now. To flip or subdivide land, you need a capital of at least 3 million for a terrace house, and you probably need to take on a semi-D to subdivide, right? And into terraces. And to subdivide, you need that capital plus refurbishment. You need about $6 million worth of capital to do that. And so that is a very difficult proposition for most of us. This house price to apartment ratio, does it exist in other cities as well worldwide? Are houses appreciating at a faster rate than apartments? Let's take a look. Melbourne, 2012, house price was $860,000. Apartment was $460,000, a ratio of 1.87. August this year, house price 1.56 million, apartment price 567,500. The ratio has gone up to 2.75. So houses have appreciated by 81.3%. That's 6.83% per annum. Units or apartments have only appreciated by 23.4%, or 2.36% per year. And this pattern is repeated in almost every major city in Australia, whether it's in Melbourne, Sydney, Perth. The house prices have appreciated at a much faster pace than apartments. Let's move on to Auckland. Auckland's average 3 to 4 bedroom house is 964,000 Kiwi dollars. Units are 643,400. Ratio 1.5. Units appreciated by 8.7%. Now, the data points is a bit short. It's only about 4 years, but 8.7% appreciation of units over 4 years. That's 2.11% per annum in Auckland. Houses of 3 to 4 bedroom appreciated by 9.94% or 2.4% per annum. So you can see that even in this short space, houses are appreciating slightly faster in Auckland than apartments. But remember this, the ratio is only 1.5 times. Okay, will it eventually go towards 2.5, just like Singapore and Melbourne? I think so. Now, Auckland's population growth is 4% compared to Singapore's 1%. The weather, the climate is beautiful. It's a beautiful city if you have been there. And people in all over the South Island, they're migrating up to Auckland. So it's becoming an international city, right? And Auckland does not have capital gains as of now, and there is no inheritance tax as well. Next, let's look at the major cities. London, average semi-detached, and I chose semi-detached because it's a midpoint of terraces, semi-detached bungalows. I was looking at all the landed data, so I picked the midpoint. Semi-D, 732,731 in 2021. In 20 years ago, it was 268,409. The increase was 173%. That was 5.15% per annum. That's faster than Singapore's 4% for landed, right? Average flat price is 517,548 pounds this year. 20 years ago, 198,446, increase of 161%. That is 4.91% per year. Okay, the ratio has also crept up from 1.35 in 20 years ago to 1.42. So you can see the trend, even for mega city, is happening, right? House price has outperformed apartments. Birmingham, second largest city, population about over 1 million. Average semi-D, 225,649, 2021 this year. And 20 years ago, 90,285. Average increase, 150%, that's 4.69% per annum. That's more than Singapore again, right? Average flat price, 159,316. 20 years ago, 68,376. Increase of 133%, that's 4.3% per annum. Ratio was 1.32, 20 years ago, 1.42. Again, you can see the ratio has increased. So anywhere outside London, okay, you should, my advice is to buy houses, not buy apartments, and definitely not buy new apartments, because I have cases where I've seen new apartments being sold at 250 to 350,000 pounds for 700 square foot, when an old house, an existing house next to it, could be sold at 225 to 250,000 pounds. And most Westerners, they like to live in houses because they want to grow up in gardens. Hey, I grew up in Malaysia in my childhood, right? I mean, there was a backyard and I played with my cousins, and then we were doing stupid things like riding on bicycles, falling down, getting cuts. And then lunchtime, all of us would go and eat, go back to the house to eat, and then we'll be out running until evening, and then we'll come back. And those were the fun years. So growing up in a house is going to be increasingly rare, and it's sad to say that the future generations will be more used to growing up in balconies. They will miss the adventures and the joys that I had in Malaysia. So Manchester, third largest city in UK. Population is 500,000 for the city itself, but the metropolitan area, which is the built-up areas, urbanized areas, is over 1 million. Average semi-D was 224,000. 20 years ago was 80,000. Increase of 178% or 5.3% per year. Again, that's faster than Singapore's landed. Average flat price, 195,660. 20 years ago was 73,500. The increase of 166%, that's 5.01%. So again, the ratios have increased. In 2001 was 1.09. In 2021 is 1.14. Now, Manchester city itself, do be careful. In the city center, there are a lot of new builds. They are very tall towers. These represent supply. And with all these new builds coming up, you could see the rents actually falling. It will take a long time to absorb the supply. When you see tall towers, do be very careful, especially for residential. It's good for commercial because all the people moving into these tall towers will be going shopping and eating, drinking around the pubs in the area, but it's the opposite for residential. So in the city center of Manchester, do be very careful. I wouldn't touch an apartment. Now let's look at a big city like New York. Average single family home is 791,000, 2,000 this year. 10 years ago was 485,000. The increase was 63.1%. That's 5.9% per annum. Again, the increase is faster than Singapore, right? So the average condo is 967,000. And then 10 years ago was 675,000. So the increase is 43% or 4.3% per annum. So the ratio is 0.72 10 years ago, and now it's 0.82. Interestingly, New York is the only place where a condo is more expensive than a single family home. So I wonder, right? And I'm going to explore whether I should buy a single family home in the city of New York. Now, you can see that the price trend of single family homes in New York has been rising very quickly, whereas there's hardly any dips, okay? But I think the problem with condos and co-ops, every time there's a new apartment being completed, suddenly there's overhang of supply, and then it just goes sideways. So from 2016 to now, hardly any capital appreciation. Okay, that causes volatility. So remember, supply from tall apartments causes volatility in prices. Now, let's look at Bay Area, which is San Francisco, Oakland, Hayward, Metro. A single family home, 1.52 million. 10 years ago was 595,000. Wow, that's an incredible place. So remember, that area is where Silicon Valley and a lot of tech hubs are there. So increase of 155%, that's 10% per year. Wow. So average condo is 1.02 million. 10 years ago was 459,000. The increase is 122%, that's 8.6% per year. So 10 years ago was 1.3, now it's 1.49 times. So you can see even then, again, the trend is consistent, right? This is the condo apartment capital appreciation, right? Below here. Now, this is a phenomenon that's happening all over the world. So my thoughts are that if you miss the boat or the ship has sailed in Singapore, right, you can't afford a semi-D or a landed now. Because if you were to get a terrace right now and it costs about 3 million, you probably need to sink in $1 million into as equity and then borrow about 2 million. You could end up paying about $7,000 per month, depending on the age. It could be $10,000 per month. And it puts you in, and if this is your home or residence, it puts you at stress. I don't think the house that you live in, as Robert Kiyosaki said, is not an asset, it's a liability. And to borrow so much money, it is actually not generating income. So putting $1 million into a house, okay, just to put into the landed, when you could have been buying S&P 500 or good stocks like Amazon, Facebook, Tesla, then there's a huge opportunity cost where all your capital is tied up and all your eggs in one basket. Unless you are worth over $100 million, then that's a different thing. So, and also your mortgage stress of $7,000 to $10,000. What if you lose your job? Okay, you're going to be in trouble because you can't rent your rental income. Even if you move out, your rental income can't cover the mortgage. So to me, if you are not of ultra high net worth worth over 50 million, it is really not advisable. So what I will do is that if I miss the boat, I would chase after countries or cities where the ratios are still very low, 1.3, 1.4. So you look at New York, look at Auckland, look at London, Manchester, Birmingham, where the ratios are still very low, right? Now, if you find the evidence and the information that I review useful, please like and subscribe. It helps in the algorithm, and next time you will see more of my videos. The reasons for this happening is underbuilding of residential homes in developed countries with strict planning controls. And one thing good about developed countries, they do not allow you to build tall buildings because it destroys the skyline, and everybody wants to see the sky. You don't want to look at neighbors' windows. So they phase out the supply. So the land have height restrictions and it causes underbuilding, but it preserves the heritage and the history of the city. And it also prevents overbuilding. Now, the next thing is protection of green belts. Just like in Hong Kong, London, major cities, they treasure their green belts. They do not allow you to rip open the parks and green belts and build more buildings, and it becomes an urban jungle. So you can't increase the supply of landed properties by building further out, right? So the only way to increase supply is to build more apartments, not new houses. And the only way to increase supply of houses is to subdivide. So again, I said, go for big piece of land, semi-detached, detached houses. They will appreciate a lot more in value in future. So next, even if they allow you to sprawl further out, just like Melbourne, I think it spreads out up north. There's a lot of land and house packages. The urban sprawl is very bad for environment. So imagine your good schools are far away, your workplaces are far away, about 20, 30 kilometers away, just like Los Angeles. There's going to be huge traffic jam coming to work. So I wouldn't touch land and house packages as well, because they are often sold in phases. And when the developer tells you it is being sold for $1 million, and then there's capital appreciation because the next phase is 1.2 million, it actually is not a capital appreciation. They merely mark it up to a higher value, and you try to sell it, it has to be way below what the developers are selling in order to get rid of it. I've experienced it myself. I've seen it myself. So, and if the property market goes down, the developers will keep the price the same, but sell at smaller parcels of land, okay, in order to get their profits in. So lastly, money seems to be flowing into assets with limited supply. Example, Bitcoin landed properties, art, wine. The rich are parking their money in what's rare, okay? So that is also another reason that landed properties, houses, things with very high residential buildings with very high land content are appreciating much faster than what's not rare, with unlimited supply. So another example I want to show, in June 2021, we had a buy to rent. Now this was COVID was tapering off more or less. So we bought it in Manchester for £230,000. Hardly any fees and refurb. Total is £10,000. So total gross development cost was £240,000. It was a corner terrace. We took a bridging loan of £140,000 at 8% per year. Equity was 100,000. Valuation report came out at 230. Money left behind after mortgage likely to be 36,900. So expected net rents after mortgage is 11,100. So we assumed zero capital appreciation since we bought it. It was at market price. So return on investment is 30% per year. So in summary, flip was done by small developers in Singapore back in 1990s and early 2000s. When landed properties can be purchased below 1 mil, refurbished for 300,000, sold for 1.8 million. Flip works on an upcycle and you can accurately control costs, then it works. And you can flip for cash flow, make $50,000 to $100,000 per flip, 25 to 50% profit. Now, my preference is buy and hold. That is where everybody who are not multimillionaires or there is not ultra high net worth can afford. It is more tax effective, able to generate intergenerational wealth. Okay, you do not incur any taxes until maybe inheritance tax when you pass away. From 100,000, you can build a wealth of 3 million in 10 years. Okay, you need to choose properties with a strong chance of capital appreciation. You've got to be very careful, and positive cash flow when you leverage. There are not many cities that generate positive cash flow for landed properties when you buy, but there are still some that are out there. I think Auckland, Birmingham, Manchester still provide positive cash flow, New York. So buy what's rare. Buy houses in overseas markets where the house price to apartment ratios are still below 1.5. They will eventually outperform, and in most major cities will eventually hit 2.5 times. So I don't know about you. I will be going out snapping all the houses in cities like that where the ratios are below 1.5. Imagine buying up a place that is worth £200,000 to £300,000. I think in 10 years' time, they'll be worth £700,000. So you got to identify, and it's a time machine. Imagine you miss the boat in Singapore, the ship has sailed. What do? Look back at other countries where the ship is still on the dock and the chance is there. So you want to find out more of how you can embark on this exciting journey, sign up for my webinar and I'll see you there.